Hey, good morning, everybody. This is Tyler here. Tom's power just went out about a minute before we were about to begin, so he's figuring that out, trying to get everything pulled up on his laptop, and he should be back here soon. All right, thanks.
Hey, good morning, everybody. First, Tyler, just want to make sure you can hear me okay. Can everybody hear me?
Yeah, I can hear you. Can you hear me?
Um, just checking to see if everyone can hear me. Okay, there we go. Cool. All right, thank you. Really sorry for the inconvenience this morning. Actually, power here has gone out twice this morning. Has nothing to do with weather, so I don't know what's going on, but had a quick blip about 30 minutes ago. Went off, came right back on, and then literally right before the show was getting ready to start, it went out and it's still out. So I'm not sure what's going on, but it'll be a little bit more difficult, I guess. I don't know if the sound is coming across as crisp. Obviously, I can't use my microphone because it's without the power. I can't use that. So I'm using the built-in microphone on the computer. So I'm not quite sure how that's coming across, but we'll go ahead. I think what I'll do is just do an abbreviated session this morning. I can't use my big screen, my Thunderbolt screen. So I was just going back, um, resetting a lot of my screen sizes so that they'll fit on my regular screen. It's probably not going to be that great today in terms of quality, but we'll go through and at least you can get my thoughts on the market before we open. But I'm probably going to make this maybe a quick 10 to 15 minute um, presentation. So let me go ahead and get things rolling here as far as screen. Um, I'm not sure. Oh, now I can't seem to get my other screens up.
Is it not working when you press present?
All right, this may turn into a radio broadcast. um, uh, yeah, I can't get to my other screen.
Yeah, I think you have to pull it up on your laptop screen because the other screen isn't connected to your laptop, probably. Like the laptop that you're using.
Still trying to figure it out. Hold on. All right, I'm going to try something here. All right, I'm gonna give this a shot here. Still not. Yeah, I can't get the other screen to come up. All right, I'm just going to go through and just talk a little bit about the market. This will be a really brief morning update because I can't seem to get my screens to come up either. So let's go ahead and start off first with the futures. We got the Dow futures currently up 59, S&P 500 futures up 16, NASDAQ futures up 80. So we're definitely seeing a little bit of strength there. Nearly 0.5% on the NASDAQ futures. So seeing a little bit of strength on a relative basis in the NASDAQ. In the small caps right now, the IWM, now it's not letting me get into another. Oh, there we go. All right, now I can't get into my internet on my other computer. This is a mess. We're gonna have to cancel the show. I'm sorry, I'm unable to pull up my other screen, my other computer. We'll just have to wait for tomorrow. I can tell you, without looking at screens, that there's no economic news out today. So most of the market's going to be driven by earnings. Number of earnings that were out, I did take a look at them. I'm trying to think some of them that came out. I know Chipotle came out after the bell yesterday. Good report there. I know pre-market action this morning was, I think it was up about $60 to about $25.50. I looked at Uber this morning. I saw that was down slightly, and that was probably an hour ago, so that could have changed. But I think that was down maybe $1 or so this morning. I know that there was a really bad report on Snap, which lowered its guidance for the upcoming quarter. I believe they beat on both top and bottom line for the last quarter. But the last time I looked, Snap down about 30%. So that's going to be one that's really going to be struggling right out of the chute this morning. ELF, I don't know if you're familiar with this company, Elf Beauty, but this company has done extremely well for a long period of time. They beat again another raised guidance, which is what they seem to do every quarter. I know that stock was up probably close to about 7%, I think, from what I recall. And then I think there were a couple of others, but I didn't see the reaction to those. I know Roblox was reporting, Prudential, some other big names. Actually, I can give you some of those names. Lilly reported this morning, or excuse me, Lilly reported yesterday morning, so that's not really one I'm interested in. Amgen reported after the bell yesterday, beat on the bottom line by about 5 cents, 471 versus 466. Gilead came up short in its earnings. Chipotle, which I was just talking about, their expected earnings were 973, came in at 1036. So nice beat there. Let's see, pretty good reaction. I know yesterday after the bell, Fortinet, FTNT, that was up considerably after the bell. They beat on their earnings 51 to 43. And then this morning, Alibaba missed, coming up short, 267 versus 273. Uber expected to come in at 15 cents, came in at 66 cents, but the stock was still down. I didn't see the whole report, so I don't know what traders were focusing on there. Hilton beat estimates 168 versus 156. Roblox came in better than expected loss of 57 cents. It came in with minus 52 cents, so 5 cents better than expected. So I think the market's going to trade a little bit off of earnings. One thing I did want to let everyone know is that, I've talked about this before, but I just want to remind everyone as we get closer, we're only about a week away from the middle of quarter 1. And that's significant because in the first half of quarter 1, which goes till February 15th, the NASDAQ, since 1971, the NASDAQ in its history averages its average annualized return for the first half of the quarter is plus 31%. The average for the second half of the quarter is minus 0.11%. So the first half of the first quarter tends to be when we get all of the strength in the NASDAQ. And now we're only a week away. We've seen a lot of growth-oriented stocks, many stocks within technology, communication services, discretionary, even some other aggressive areas, or I guess semi-aggressive areas, financials, industrials. We've seen a pretty good move in many individual stocks within these areas. And I just want to point out that those tailwinds that we've been experiencing based on history come to an end next week. And we do tend to see the market struggle, especially from about February 15th to early March, maybe around the 10th to 15th. So that period is coming up, getting closer and closer. The S&P 500 with today's potential gap up, we're going to be getting closer and closer to that psychological number at 5,000. Any kind of a big reversal, morning strength looks good in the morning, and then all of a sudden big selling in the afternoon could be a short-term top. And I've been talking about this a lot because they're negative divergences. We've got short-term issues. I don't know if you've seen, but if you look at the S&P 500 and the VIX on a daily chart, the correlation is positive, which is normally a signal that, hey, we need to be at least on alert for a possible reversal in the market short term. So all these things kind of coming together, they're all short-term signals, but they are signals nonetheless, and they do favor the bears. So I don't like to argue with a secular bull market advance. You hear me talking about that all the time. I'm fully invested on the long side, but I do think you need to be a little bit cautious, whatever that means to each of you. I don't know if it means, that opens the door to you shorting if you want to. I mean, I'm not a fan of shorting in a bull market, but everybody's different. It could mean simply moving more to cash, maybe cutting your positions by a third or a half, or just, sitting more in cash, avoiding leveraged ETFs. I talk about leveraged ETFs a lot. I think as we now get closer to 5,000 on the S&P, second half of the first quarter approaching, I don't think this is a great time to be sitting in leveraged ETFs. Maybe you get a trend, you can run for a few days with it, but I would be really careful about just sitting and holding leveraged ETFs during a period that can be a little bit challenging at the least. All right, I'm going to go ahead, I think, and wrap it up for this morning. I really apologize for not being able to give you more information. Actually, I got one other shot on this other computer. Let me see if I can maybe, just maybe. Yeah, it's not working either. Oh, maybe it is. All right, let me try. I think I can give you a little bit more information here. So I know maybe if you pull up your own S&P 500 chart, I do have the charts up on my other computer. Unfortunately, I can't get to them on the current computer. But I mean, if you look at the daily chart, you'll see the S&P 500 moving higher. Still got a lower PPO. That's a little bit of a concern. Now, if you look at where the 50-day moving average is, because what we look for with the negative divergences is perhaps a 50-day SMA test. 50-day SMA right now on the S&P is at 47.43. So that would be about 200 points. So we'd be looking maybe at about 4% on the S&P 500. And if we do get up another 1%, we challenge that 5,000 level, that would then give us perhaps maybe about a 5% target to the downside. Again, I don't know if we see a 5% decline, but I just wouldn't be shocked by one. Just knowing what we know about history, looking at some of these charts and some of the short-term warning signs that are flashing, that's possible. So if I'm somebody who's maybe investing longer term, I'm probably looking at any weakness as short term. I would ignore it and just stay the course, because the problem is if you get in or if you get out, if you're a long-term investor, you get out and you wait for this 5% move to the downside and it never happens and the market keeps going higher, what do you do? And that's why, as a long-term investor, any kind of short-term issues, I would just ignore and just ride them. I mean, that's what you're doing as a long-term investor. Now, as a trader, if you've been doing well and we get a 5% pullback, you're going to end up giving back a lot of your gains. And capital is everything from a short-term trading perspective. So that's why if you trade more than you just simply buy and hold, then I would be a little bit more cautious in this environment, willing maybe to even give up a little bit of upside to avoid perhaps a 4 or 5% hit to the downside. The NASDAQ 100, really trying to get through about that 17.7 area. I mean, I'm just going to read you a couple of numbers over the last 2 weeks. I want to give you some intraday highs going back to January 24th. 17,665, 17,631, 17,604, 17,682, 17,655, and 17,680 was yesterday. So clearly, if we get the 17,700, we will then once again on the NASDAQ 100 be at an all-time high. And it's really hard to argue all-time highs. But just remember, February 15th around the corner. And one thing I was going to show you on the charts, maybe I can do this tomorrow morning, was I was going to show you the way the year normally unfolds during an election year. So I showed that back in Market Vision 2024, but I had it ready to go today. I was going to show everyone what that looks like. And what I can tell you is that it is right around the 15th of February that we tend to see a decline into the first or second week of March. That's in election years, but that's also in all years. So, this is a period that, we need to at least recognize as one that could see a brief market decline. And that's just based on history. That's not a guarantee. It doesn't happen every year. I don't want, this, blown out of context. It's a tendency in the market. So there have been plenty of years that the market's gone up from February 15th to early March. Plenty of years. But the average, the typical behavior would be a pullback from February 15th to early March. Looking at the IWM on the daily chart, if you want to pull that up on your screen, kind of follow along. We topped back in December. We have seen underperformance, I think, really last week with the Fed announcement. I mean, if you go back and you look to last Wednesday when the Fed announced, clearly the worst performing area, at least in terms of major indices, has been the small caps. And if you look at the bank index, the DJUSBK, you will see that we have had steady decline since the middle of last week. You also, if you look at the KRE, which is the regional banking ETF, you'll see the same thing. And I don't know if you recall, or even if you were following me back in 2022, but if you recall, when I called the bottom for the S&P 500 in mid-June, we went up 700 points. We're about 3,600 and change, I think, on the S&P 500. And by middle part of August, which was less than 2 months later, we were at 4,300. We were making a massive rally. I mean, it looked like my beginning of the year forecast, which I had suggested we might see a V, where we went down through June. I mean, I suggested this all the way at the beginning of the year. Went down through June, and then by the end of the year, we were back up. Through August 15th or 20th or so of 2022, it looked absolutely like I had predicted the future to a T. We went right down into June, bottom, turned right back up. And then if you recall, August 25th, it was a Friday, and the Fed was out in Jackson Hole, and my good friend, Fed Chief Powell, came out at that time and said more pain ahead. And from that, and actually, I think we had already started to turn lower, and then we accelerated after that speech. I remember August 25th, 2022. You can go back and look at it on the chart. Big red filled candle. You're not going to miss it. And that led to a retest in October, actually going a little bit below the June low. Before then, we rallied. So effectively, what the Fed did was kind of strike a little bit of fear in the market, and we ended up having like a little round two of that cyclical bear market before we actually bottomed. I think what happened last week, and I've said it the last couple of days here since the Fed reported, but I wasn't very happy. I don't like the way the Fed just kind of changes their stance, even if it's just a little bit from meeting to meeting. It drives me crazy because they tell the market one thing, the market, really starts going based on that data, and then the Fed will come back and say something else. Perfect example, 2 meetings ago, the Fed said that they were going to have 3 rate cuts instead of 2 in 2024, that they were looking at an additional rate cut. Then, just last week, the Fed, and of course the market was rallying. We had a big rally just like we did back in June, July 2022. And then the Fed on Wednesday of last week said, well, we may not cut rates as much as the market believes we will. And so literally from 1 month to the next, it's going from more rate cuts than what we previously said to now saying we're going to cut less than what the market expects. And trying to decipher between the lines on what the Fed is doing is almost worthless, but it has an impact. And when you start talking about rate cuts being pushed back, because they also said don't expect to cut in March. So as the market now digests the fact that rates are going to be cut, but they're going to be cut later, that pushes back the timetable on banks. Because my theory with the banks, and I love the banks, I don't care if they go back down here for a little while. I believe they're going to come roaring back because I audited banks when I was in public accounting, and I know how important that interest, net interest margin is in banks. And banks have had to struggle with an inverted yield curve for a while. And so, our 10-year treasury yield, I don't believe is going to fall a lot. I think it could go back down. Maybe it goes down into the lower to mid threes, possibly goes into the twos. I don't know. But what I do know is I think there's going to be a number of rate cuts at the shorter term level. The Fed funds rate is going to come down. And so the shorter term maturities rates are going to come down pretty rapidly once the Fed starts lowering. And so what we're going to see is a reversal of that inverted yield curve. And so then we're going to see that spread start building. When that happens, the bank's profits are going to go up significantly. Now, the market doesn't wait for those profits to go up. The market will buy into those areas before we ever see those profits start to go up. And so I think the banks in the fourth quarter were starting to get going, and I think the Fed put a kibosh right on it. And so now we're faced with, okay, what are we going to do? When are the banks going to be back in favor? I honestly can't tell you. It might be next week. It might be next month. It might be next quarter. But it's the largest holding in the IWM. So that's why we're struggling right now in the IWM. It's why, in my opinion, the KRE is struggling, because basically the Fed decided that, hey, we're going to make the market push back the time frame in which some of these rate cuts are coming. So, for those who think the Fed has nothing to do with what goes on in the stock market, I beg to differ. I think just their words alone can make a big difference. And with Powell, you never know what the heck that dude's going to say from month to month, meeting to meeting. I mean, I know what the Fed is going to do in terms of rates, but I don't have a clue what he's going to say month to month. And the market seems to just go up and down sometimes and make reversals based on what he says. So if you've noticed, the stock market hasn't come down. It's just some interest sensitive areas that have come down, interest rate sensitive. So anyway, the market did just open. Let me at least give you the update here as we get started a new day. We got the Dow up 141, S&P up 22, NASDAQ up 71. So the S&P and NASDAQ both up about between 4 and 5/10%. Small caps flat. So again, small caps doing nothing. Let me give you the KRE. KRE down 23 cents. It's just continually dragging the IWM down. IWM opened up. Now it's down 44 cents, 193.23. I think it's possible the IWM goes back down to that 187.50 area. We're kind of clinging to the 50-day moving average, and we're also clinging to the 20-week EMA. So the shorter term moving average on the 20-week. If those two levels can't hold, then 187.50 is almost a slam dunk. And maybe we even get a little bit lower just to, I don't know, thin out the crowd, thin out the bullish bankers, the bullish small cap folks. Wouldn't surprise me. But anyway, IWM right now down a little bit this morning. I can tell you stocks like Snap, currently at $12.14. It's down 30% overnight. So when I talk about the risk of holding into earnings, I want you to picture Snap. That might be a little outlier, losing 30%. But when you get into some of these companies that are very, very aggressive, you absolutely have to be careful. CMG, which opened at 25.61, is currently at 25.42. ELF, which I talked to you about, that was up like 10 this morning. It's now down 10, heading back for its 20-day moving average test. So big reversal on that one. Uber, I mentioned earlier. Uber had gapped down. It had gapped down to about maybe $3 or so. And now it's down 85 cents. So it's actually gapped down coming back. But those are some of the big ones. Let me give you Alibaba, which missed. But this stock's been beaten up so badly. It was maybe around 78 at the close yesterday. It opened this morning at 74.56, but it's now back to 76.13. Might be a case of, a lot of bad news already built into the stock. I don't know. Anyhow, I'm going to go ahead and wrap up. I really want to apologize. Unfortunately, it's out of our control. Power went out literally right before we started the show, like 2 minutes before. And so I've been scrambling, trying to at least give you something here. So it's been more like a radio broadcast, but I guess that's better than nothing. Anyhow, somebody did ask about Tesla. I'll give you where Tesla is right now. It is up. It printed a bullish engulfing candle yesterday, so it's up today, but that's kind of what I would expect it off that candle. I still think it's got issues. I believe the 195 to 200 level short term is your resistance area. Maybe it runs up that high, but I'm not going to be overly excited about Tesla until we can at least begin trading above the 20-day EMA. And that right now is quickly moving down to about 200. Someone mentioned Ford had reported. Yes, they did. They gapped up. Stock is up about 5.5% right now at $12.73. Anyhow, that's it for me. I am going to try. I'm hoping the power is back. It's going to be very difficult to do a trading room at 10 o'clock this morning if I have no power. So just be on the lookout. Check your email, because if my power is not back within the next 20 minutes, I will cancel today's trading room. And I'll send out an email to let everyone know. So anyway, make sure you're checking your email, and I'll try to get that out maybe around 5 till 10. If I haven't had power back by then, I've got about 15 minutes. I will check with my power company and see when it's expected to come back on. But at least for right now, it's possible we don't have a live trading room today. So again, I apologize, but hopefully things will be back in order here shortly. And if not, then hopefully see you tomorrow morning for Trading Places Live. Have a great day, everybody, and happy trading.